Over 60% of adults worldwide don't know how to invest their money effectively. Quite a startling statistic, isn't it? This number is more than a statistic. It's a reflection of a knowledge gap in our financial well-being. Investing isn't solely about profit. It's about securing our future and gaining financial freedom. Yet, many are uninformed on how to effectively do this. A reason for this is the numerous investment strategies available. Stocks, bonds, index funds, real estate, each with different pros and cons. Understanding these can lead to informed decisions. Stocks offer potential high returns but increased risk. Bonds are safer but offer lower returns. Index funds aim to replicate a market index, balancing risk and reward. The secret to successful investing isn't finding the perfect strategy, but understanding these strategies and choosing the suitable one based on your financial goals and risk tolerance. It's about being rational, disciplined, and consistent. Throughout this series, we'll delve into these strategies, demystifying them for you to navigate the world of investing confidently. So, are you ready to break free from the 60% and take control of your financial future? Join this journey to explore various investment strategies, which might just be the key to unlock your financial potential. Before you step into the world of investing, it's important to know where you're heading. Having clear and realistic financial goals is the first step towards successful investing. It's like setting the destination for your investment journey. Without it, you may find yourself wandering aimlessly, not knowing whether the choices you're making are leading you closer to or further from your desired financial future. Clear financial goals provide you with direction, motivation, and a benchmark to measure your progress. They also help you decide where to invest, how much to invest, and how much risk to take. Usually, financial goals fall into three categories: short-term, medium-term, and long-term. Short-term goals could be saving for a vacation, building an emergency fund, or paying off a small debt. These goals usually require safer investments like savings accounts or short-term bonds. Medium-term goals could be buying a house or saving for your child's education. These might require a mix of safer and higher-risk investments. Long-term goals could be saving for retirement or building a large investment portfolio. These often require investments that grow over time, like stocks or index funds. Each type of goal requires a different investment strategy, and a clear understanding of these can help you make better investment decisions. Set your financial goals and let them guide your investment journey. Stay disciplined, stay patient, and let the magic of compound interest work for you. And remember, it's not about timing the market, but time in the market that counts. So, are you ready to set your financial goals and take the next step in your investment journey? Let's dive deeper into the world of stocks and bonds. In the wise words of Albert Einstein, compound interest is the eighth wonder of the world. Those who understand it, earn it. Those who don't, pay it. But what exactly is compound interest? It's a process where the interest you earn on an initial investment also earns interest. In other words, it's interest on interest. It's a snowball effect. As your investment earns interest, the total amount increases. Then, the interest is calculated on this new, larger total. Over time, this can lead to exponential growth of your investment. The magic of compound interest lies in its potential to significantly increase your wealth over time. Let's say you invest $1,000 with an annual interest rate of 5%. The first year, you'll earn $50 in interest. The next year, you'll earn interest not just on your initial $1,000, but also on the $50 you earned the previous year. So your interest for the second year would be $52.50, not just $50. While the difference might seem small now, over time, it can add up to a significant amount. This is especially true if you keep adding to your investment. The more you invest, the more you'll earn in interest, and the more interest you'll earn on that interest. It's a powerful cycle that can dramatically boost your wealth. But there's a catch. To fully harness the power of compound interest, you need time. The longer your money is invested, the more time it has to compound and grow. That's why it's so important to start investing early. Even small amounts can grow into substantial sums over time thanks to the power of compound interest. So remember, time is your best friend when it comes to compound interest. Start early and let your money work for you. This is the magic of compound interest, a simple yet powerful concept that can be your key to financial freedom. Stocks and bonds, often referred to as the bread and butter of investing. These two financial instruments form the backbone of most investment portfolios, but what exactly are they, and how can they contribute to your financial goals? Firstly, let's talk about stocks. When you buy a stock, you're essentially purchasing a small piece of ownership in a company. Stocks are often appealing to investors due to their potential for high returns. If the company performs well, the price of its stock increases, and so does the value of your investment. However, the flip side is also true. If the company underperforms, the stock's price can fall, leading to potential losses. This makes stocks a more volatile and riskier investment compared to bonds. Now let's shift our focus to bonds. Unlike stocks, bonds don't give you ownership in a company. Instead, when you buy a bond, you're essentially lending money to a company or a government. In return, they agree to pay you interest on a regular basis and return the principal amount on a specific date, known as the bond's maturity date. Bonds are often considered a safer investment than stocks, as they provide a regular income stream and return the principal amount at maturity. However, the trade-off is that the potential returns from bonds are usually lower than stocks. Both stocks and bonds play a crucial role in a diversified portfolio. Stocks offer the potential for growth, while bonds provide a steady income stream and help preserve capital. The key is to find a balance that aligns with your financial goals and risk tolerance. This balance can shift over time, depending on changes in your financial situation, market conditions, and investment horizon. So whether you're a risk taker looking for high returns or a safe player seeking steady income, a mix of stocks and bonds can help you achieve your financial goals. Remember, investing is not a one-size-fits-all approach. It's about finding the right blend of investments that aligns with your unique financial objectives and risk profile. In contrast to the classic approach, a modern and increasingly popular investment strategy is investing in low-cost index funds. So, what exactly are these index funds? Simply put, an index fund is a type of mutual fund or exchange-traded fund with a portfolio constructed to match or track the components of a financial market index. This could be the S&P 500, the Dow Jones, or any other broad market index. One of the most appealing aspects of index funds is their inherent diversification. With a single investment, you gain exposure to a wide array of stocks or bonds, reducing the risk associated with investing in individual companies. This is especially beneficial for those who prefer a set-it-and-forget-it style of investing, where constant monitoring and adjusting of the portfolio isn't required. Another advantage of index funds is their relatively low costs. Unlike actively managed funds, which charge higher fees to cover the costs of research, analysis, and the fund manager's time, index funds are passively managed. They simply aim to mirror the performance of the index they track, resulting in lower operating expenses and therefore lower fees for investors. But as with all investment vehicles, index funds are not without their drawbacks. For instance, index funds offer little control over individual investments. You're essentially buying the market, which means you'll own both the high performers and the underperformers. Also, while index funds generally follow the overall trend of the market, they can't outperform the market. So if you're looking for explosive growth or have a knack for picking winners, index funds might not be your cup of tea. However, despite these potential downsides, it's important to note that index funds often outperform their actively managed counterparts. This is mainly due to their lower costs and the fact that beating the market consistently over the long term is a feat that few fund managers achieve. Index funds, despite their cons, have proven to be a potent tool for investors, often outshining their actively managed counterparts. Some investors try to time the market, aiming to buy low and sell high. But is it really a practical strategy? A question that echoes in the minds of many. Market timing is like that tantalizing high-stakes poker game. It's the concept of attempting to predict future market movements, with the goal of buying at the bottom and selling at the peak. It's attractive, right? Who wouldn't want to maximize their profits? Timing the market is generally considered a risky strategy, as predicting short-term fluctuations is notoriously unpredictable. Attempting to buy or sell assets based on market timing often leads to emotional decision-making, high transaction costs, and the potential for significant financial losses. There's a certain allure to this strategy, no doubt. The potential benefits are immense. If you manage to get it right, you could make substantial profits. But herein lies the problem. It's an if, and that if carries significant risks. Most professionals advise against market timing due to its unpredictability. Why? Because the potential losses can be substantial. If you misjudge the market, you could end up buying high and selling low, which is the opposite of what you want. And remember, in the world of investing, every mistake costs money. The market doesn't follow a set pattern. It is influenced by a countless of factors, from economic indicators to global events, and even investor sentiment. Predicting all of these accurately is next to impossible. So what's the takeaway from all this? While market timing might seem like a quick way to make a profit, it's far from being a surefire strategy. It's a high-stakes game. And like all high-stakes games, the losses can be as monumental as the gains. Timing the market, while tempting, can be akin to playing with fire. It's a high-risk game that can lead to substantial losses. It's an enticing game, no doubt. But remember, it's one that carries great risk, so tread carefully. From the high-stakes game of timing the market, we now move on to a different strategy, one that is more measured, consistent, and accessible to most investors. Welcome to the world of dollar cost averaging, or DCA. Picture this. Instead of trying to hit a home run by investing a large sum all at once, what if you could invest smaller amounts regularly, irrespective of the market conditions? That's precisely what dollar cost averaging is all about. Let's break it down. The dollar part refers to the fixed amount that you decide to invest regularly. The cost averaging part comes from the fact that you're buying more shares when prices are low and fewer shares when prices are high, which can result in an overall lower cost per share over time. This strategy has two significant benefits. First, it removes the emotional aspect of investing. With DCA, you're not worried about the best time to invest because you're investing regularly, regardless of whether the market is up or down. Second, it reduces the risk of investing a large amount in a single investment at the wrong time. By spreading out your investments over time, you can potentially lower the average price you pay per share. But remember, like all investment strategies, DCA doesn't guarantee profit or protect against loss in declining markets. It's a disciplined strategy designed to ride out market fluctuations. So, if you're an investor who prefers a steady, disciplined approach, dollar cost averaging might be a strategy worth considering. It's not about timing the market, it's about timing the market. As we always say, investing is a marathon, not a sprint. So keep your eyes on the horizon, stay disciplined, and let the power of dollar cost averaging work for you. Right on the heels of our discussion about the risks of timing the market, let's talk about a strategy that can help protect your investments from market volatility: diversification. Often considered the only free lunch in investing, diversification is the practice of spreading your investments among different securities to reduce risk. Picture it like not putting all your eggs in one basket. If one egg cracks, you still have others safe and intact. In the world of investing, diversification means spreading your capital across various types of assets, such as stocks, bonds, index funds, real estate, gold and commodities, among others. The idea is that if one asset or sector performs poorly, the others might perform well, thereby balancing out the losses. This strategy not only reduces risk, but also has the potential for higher returns, as you're investing in a wider range of assets that could grow. The key to successful diversification is asset allocation. This is the process of deciding how much of your portfolio to allocate to different asset classes. It's a personal decision, and depends largely on your risk tolerance and investment goals. Some may prefer to have a higher allocation to stocks for the potential of greater returns, while others may prefer bonds for their stability. While diversification can't guarantee against a loss, it is a powerful strategy to help you navigate the unpredictable waters of the financial markets. It can protect your portfolio from the volatility of single investments and sectors, and offer a smoother ride through the market's inevitable ups and downs. In summary, diversification, when done right, can be a powerful tool in your investment arsenal. It's a strategy that aims to maximize returns by investing in different areas that would each react differently to the same event. So, instead of trying to predict the unpredictable, diversify your investments and let the magic of balance work for you. We've covered a lot of ground in our journey to mastering the art of investing. Let's take a moment to recap. We started with understanding the importance of clear financial goals. Then we explored the magic of compound interest and the power of starting early. We dove into the role of stocks and bonds and the benefits of index funds. We cautioned against the risks of trying to time the market and introduced you to the strategy of dollar cost averaging. And just now, we've discussed the importance of diversification, spreading your investments across various types of assets to minimize risk and maximize potential returns. Remember, investing is a journey, not a destination. The key to success is continuous learning and maintaining discipline in your investment approach. So keep absorbing, keep questioning, and let your money work for you. Happy investing.